You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time, once again, for TWIFO, This Week in Futures Options, a program where we break down everything going on the futures options side of the fence. That could be equities, that could be ags, that could be metals, rates, energy, maybe a little thing called crypto. Maybe you heard of it, a whole bunch of activity swirling away there. We're going to profile today. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Wishing everyone out there happy, safe, healthy New Year. I know it's already off to a tumultuous start. We'll try to keep things sane and level-headed for you here on the old program. Remember, you like what you hear for this show, anything we do on the network, keep those reviews coming on your platform of choice. It really did drive a whole bunch of new people to the network in 2020, and we want to keep that going. We want to be able to give the new folks who are just discovering these markets a place to turn. So wherever you listen, keep those reviews, those comments coming. We do love to hear from you guys. And let's see who we're hearing from on the program today. First, joining me once again, I am pleased to say he's back in the FTSE Russell hot seat, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Mr. Smith, welcome back to TWIFO for the first time in 2021, sir, and Happy New Year to you.
Mark, Happy New Year. Happy New Year to everyone listening today. It's great to be back. Looking forward to having a great show and a great year. Looking forward to it.
You sound fantastic, sir. The year is already off to a bang. I love it. We can hear you so deep and resonant over there in the FTSE Russell studio, sir. All right, and also joining us from the CME Group hot seat today, a returning favorite here on the hot seat, Mr. John Brady, the Managing Director over there at RJ O'Brien. John, welcome back to TWIFO and Happy New Year to you as well.
Thanks so much for having me. It's an honor to be here, and Happy New Year to you.
All right, and before we kick it off with our first movers and shakers for the year. Sean, I know you were a little bit under the weather on our big 2020 year in review spectacular. Check it out on the feed, listeners, if you haven't done so already. I thought I'd kick the show off, give you an opportunity, and I'll give John the same opportunity as well. I'm an equal opportunity host here. To look back on the mad year, I know it was pretty tumultuous from a Russell 2000 and indeed a FTSE Russell perspective as well, Sean. So what were some of the highlights that really resonated for you during this completely topsy-turvy year of 2020?
It's 2020, and we're trying to erase a lot of it from our memory banks. But 2020 is obviously an incredibly tumultuous year with COVID, right? So we've had just a tremendous move in our index products, our large caps and our small caps. And as you know, small caps lagged large caps for the majority of the year. It was just a really difficult year for U.S. domestic stocks, and with COVID, uncertainty around the U.S. economy during this, overall, Russell caught up. I think I say this on the show almost every show, and it's small caps outperform to the downside when the market's showing weakness, but small caps also outperform to the upside when the market is strong. And once again, Russell did not disappoint in 2020 in the year 2020. Small caps just took a tear on in the fourth quarter of the year, and actually came up right next to large caps, both being up 20 and 21% for the year. But Q4 was probably the banner quarter for small caps, outperforming large caps. Small caps being up over 26%, beating large caps, the Russell 1000 by quite a large margin, with large caps only being up 15%. There's a lot of reasons behind that. One is obviously the news of a vaccine, and the second was the economic stimulus packages that the government put in place. When you hear economic stimulus for the U.S., you instantly think domestic stocks, and what is a better representation of that than the Russell 2000, which just gave us a tremendous performance into the end of the year. So there's just and there's a lot within the Russell 2000, as you know. It's not as tech weighted as the large caps, Russell 1000, but it's heavier in oil and financials. It's heavier in healthcare, and healthcare is one of those areas that there was a tremendous rally for the end of the year with the news of a vaccine. So just a fantastic year, great performance. We saw Russell 2000 trade over 2000. As we enjoyed talking about in the last couple of episodes of the show. I also wanted to bring up that it was the year for our partners at our exchanges. Micros just absolutely exploded in volume and open interest at CME Group, Micro Futures, and the Russell suite of futures and micros did extremely well as in historical numbers as well. And at the end of the year, we had our partner at Cboe Global announce they're going to be launching mini Russell options, which should be coming out in the first quarter of this year. We're extremely excited about this new product launch for Q1 of this year, all because of the client demand for more access into small caps. And a nicer notional size. These micros at CME have just been fantastic. And now with the mini Russell options coming out at Cboe as a fantastic complementary product, I think 2021 is going to be one of those very exciting years in options for us together, Mark.
Yeah, I just realized, Sean, we forgot to have our Russell 2000 party. We missed it.
It's not too late.
Not too late. Coming in to kick off a show here, we're at 2,085 even out there. So that qualifies as north of 2,000, Sean. So we need to get our respective planning committees in gear. What do you think?
Let's get that party started.
I like that. We can have a virtual party. It's all the same. You're beaming in from the FTSE studios. I'll beam in here from the options insider. We'll send delicious gourmet burgers everywhere. It'll be good. What do you say?
Let's do it. I can't wait.
All right. Good times out there in small caps. But, John, you weren't able to join us last week on our show, so we'll give you the same chance. Again, egalitarian host that I am. Obviously, it was a just completely insane, topsy-turvy, add in your adjective of choice to describe the year that is 2020, and it'll probably be underselling it. It was unprecedented, but it's about any degree. And I'm sure you guys saw a lot of interesting things, a lot of interesting trends What really resonated for you on the year from a futures and futures options perspective, sir?
Well, Mark, I think the one thing we take away from last year is the reaction function by the Federal Reserve in terms of its efforts to support the economy. Coming out of the global financial crisis in 2007, 2008, there were a number of the Fed cut rates to zero, and then fiscal policymakers added in an amount of stimulus that was less than $1 trillion. And the economy from, let's say, 2008 to 2012 grew at a very subpar pace. In 2020, the Fed came in, immediately cut rates, and fiscal policymakers reacted with $3 trillion of fiscal stimulus within the April-May period. And that's really helped buoy asset prices across the globe, here in the United States and whatever else. So the one lesson we take away from 2020, to be short, is that the reaction function of government officials, both at the Fed and with fiscal policymakers, and with Fed officials and fiscal policymakers working together, was really much bigger, much greater than it was coming out of the global financial crisis. And I think we're seeing that. I think we saw it with the Russell 2000 in terms of its performance in Q4, and I think we're going to see it probably bleed into 2021 as the markets have already indicated in the first week of trading.
All right, thank you for that, John. And now it is time to commence the show proper, do it official. It is time for our first Movers and Shakers report for 2021.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, let's kick it off. Time for our first Movers and Shakers of the new year. If you heard our Movers and Shakers for the year on our episode last week, the 2020 rundown, it was pretty much all green all the time. We were hard pressed to find a bottom 5 movers of the year. That's how crazy of a year it was in one direction. This week, a little bit different, still heavily dominated by green, including one that's almost literally off the charts. We'll get to that in a second. You could probably guess what that one is, listeners. Let's start, though. Well, actually, I'll let our guests choose, as I am wont to do. John, where should we begin our journey for the year, for the new year that is 2021, sir? To the light side or to the dark side?
I think it'll be probably to the light side. I mean, I think the path of least resistance for risk assets markets are probably to the upside in the short term. Look, we're going to get a new administration. I think a change of policy and change of administration is going to buoy risk sentiment and confidence within the economy. And then likewise too. Look, I mean, we argued this to clients this morning. We think that because the GOP is fractured, Democrats will have the upper hand in all chambers of Congress, and we think that should that having been said, there's only upside to fiscal stimulus. Recent chatter out of some major Wall Street banks today has been that fiscal stimulus in the coming weeks after the Biden inauguration will probably be closer to $1 trillion, and then using budget reconciliation in the June, July, August timeframe, you'll probably see an additional $3 to $4 trillion in stimulus come through. Some of that will be, for Green New Deal initiatives and things like that. But really, there's a ton of liquidity and money flowing in the system. There's even more going to come back in. And look, as the marine layer and the fog of both political uncertainty and COVID lift, animal spirits will come forth even more. Workers, restaurant workers, for example, theater workers, for example, will go back to work. That will lift sort of the bottom rung of the economy. And so, look, we think there's probably room to the upside as it relates to risk assets. It's a bad time to short them, we think, so early in the year and with so much liquidity flowing around.
All right, sir. An interesting preamble here to the movers and shakers. You went light side, so we're going to have to kick things off to the light side, including the number one, which is just insanity. We'll get there in a minute first. Number 5, listeners, we were just talking about it. The Russell 2000 up nearly 5% for the week, 4.87% for the week. That's that catch-up Sean was talking about with the 2000, catching up to the 1000, small cap, catching up to the large cap. Been quite an impressive Q4 for Russell 2000, and so far, at least, Q1 looking pretty aggressive as well. That would usually be enough for maybe top placements. This is just a week, listener. We're not going back a year. It's just a week. But no, that's how crazy of a week it has been. Number 4, just edging it out ever so briefly, our old friend, Class 3 milk, up exactly 5%. Number 3, iron ore, another frequent offender on our list, up 5.52%. Number 2, nat gas, a perennial mover and shaker. Upside, dark side, doesn't matter. It's always moving every week. This week up nearly 7%, 6.93%. That you might say 7%. That's not enough for the top of the list. No, it is not, listeners, because number 1 with a cannon, not even a bullet, with a cannon this week, listeners, is Bitcoin. It is almost literally off my chart here, listeners, as I'm looking at it for the movers and shakers. Up 33% in a week. It's threatening 40,000 as we are speaking, listeners. It boggles the mind, the levels we're seeing out there right now. In fact, if you go back to our Crypto Rundown show from just a few months ago, wasn't even that long ago, we roundly mocked a trade that went up for size. It still is. I think coming into this show today, I think it was the largest open position in Bitcoin options. That was the Jan 36,000 calls. It went up a couple of months ago, back when Bitcoin was, about 20,000 points lower. They seemed ridiculous. They seemed like they were probably some sort of risk management trade for someone out there who wanted to free up some naked short units they had. Either way, they were roundly mocked. But just the options leg, we don't know what else was against it, obviously, but just the options leg alone is now looking amazing. Those calls coming into Showtime were, $3,000 in the money? Just insanity. That might be the trade of the decade. We'll have to run the numbers on it. Probably we will for our Crypto Rundown program. But that was obviously out on Deribit, not on the CME contracts. I think we'll have to start, just because it's so insane, I think we'll have to start in the land of crypto. John, I know this is still a contentious area for a lot of traders out there, a lot of firms, a lot of brokers. It's kind of still, in many ways, an unregulated asset class. People are still kind of coming to grips from it. What are you guys seeing over there at RJO from a crypto perspective? Are you getting a lot of client inquiries about it? And what, if anything, do you guys offer or plan to offer in the near future, sir?
Well, like all FCMs, we do have a Bitcoin offering. Look, we hew pretty closely to margin requirements of the exchange, and simply pass those along to our customers. And margin requirements are high. I think from a macro perspective, Mark, I think Bitcoin is the perfect example of exactly how much liquidity is sloshing around the financial markets. Look, I think the key with cryptocurrencies and Bitcoin specifically, as it relates to institutional investors, which is really kind of what we do a lot of here, is the diversity it offers. So look, there are two major themes that come in with the whole Bitcoin story. First, it's a diversity asset. It's an asset that offers diversity and is uncorrelated to other assets. Secondly, given what the Fed and fiscal authorities have done regarding monetary and fiscal policy and their coordination in terms of flooding the system with U.S. dollars, the dollar is probably going to cheapen. Gold has told you that to a degree this year. Silver's told you that to a degree, right? But I think really kind of what it says is, the future is kind of the future of digital currencies, and in a weaker dollar scenario, future digital currency of which there is a limited supply makes a lot of sense. So it's the uncorrelation of Bitcoin to other asset classes, as well as a view on the dollar that has kind of drawn institutional investors here at RJ O'Brien.
All right, we'll get into all things crypto in a second. First, let me just break down the other half of our movers and shakers report. It's just so easy to get sucked up in the vacuum that is crypto, but there is a dark side. As slight as it might be, there is a dark side on the tape this week. Number 5 to the dark side, feeder cattle off 1.75%. Number 4, the 30-year off nearly 2.5%. Number 3, Eurodollars off about 2.56%. Number 2, a lot of rates on the dark side this week. The Ultra Bond, 3.89% to the dark side. Number 1, Palladium off 5.11%. But like I mentioned, crypto is kind of dominating the headlines right now. It's sucking up all the oxygen in the room. You guys, in case you've forgotten, you guys can go into our TWIFO report. CMEgroup.com/TWIFO is the place to go for that report, listeners. And you too can find and generate a report for Bitcoin. Just go to the cryptocurrency section. Now, this is going to get you over there to the options on the Bitcoin futures rate at CME, which are, of course, keyed off of the Bitcoin reference rate, which is an aggregate of multiple different venues out there to consolidate that price. And as of right now, we're seeing 39,615. Wow. It's hard to say that with a straight face. Listen, yeah, those calls are $3,615 in the money. Wow, I think wow is the only way to describe that. So looking here right now, we're seeing some interesting paper. Again, only about 250 contracts on the tape this week from a CME perspective. That's a 5X contract, so you're talking over 1,000 overall. But still, the options are still kind of finding their footing. We've talked about how they launched on this show last year to a lot of fanfare. The futures are obviously doing a brisk pace. The options are still struggling to catch up there. I think, but now a lot of these institutional players are clearly diving into the space, as John just alluded to. I think we'll see more players diving in to these larger size contracts over here on CME. If you're wondering, by the way, what vol does that translate into, that front Jan future that has 21, almost 22 days to go? Oh, it's 156 volatility. It's 156. You're talking 3x what would be considered a very high level of volatility in just about any other major asset class. And yet it's hard to argue that it isn't merited given the insane swings we've been seeing out there. If you're also wondering how's the skew shaping up right now, last week the calls were 19.4% rich. This week, 5.8%. Calls coming in a little bit. Puts 5.1% cheap this week, pretty much unched to the at the money. So puts getting bid up and calls actually coming in, which is kind of interesting. But again, light volume. The number one most active contract in Jan this week was the 50,000 calls. So maybe that should tell you a little bit about where we find ourselves out there in crypto. We could keep going on about crypto. Not a lot of options paper to sink our teeth into yet, but I did want to highlight it because it is the most extreme mover on the tape by far this week. All right, John, as our guest, I will allow you pride of place, sir. Where should we hang our hat next? Which product do you think merits analysis on the show, sir?
So, look, the trade in our world, and I think the trade that has the attention of institutions here has been the sudden. Not only have we seen a tremendous rally in risk, and it's tough to sort of pick tops in markets like equities or Bitcoin, given what's going on in liquidity space. But really, I think that the next trade is probably what's going on in bonds. And the dramatic, rather strong reversal that we've seen in Treasury bonds and Treasury yields to start the year. We're now seeing 30-year bond yields approach 187.5. We're seeing 10-year Treasury yields approach 1.10 in yield. And the sense is that, again, going back to sort of liquidity function and the response by fiscal and monetary authorities, and what seems to be sort of an emboldened Biden administration to further stimulate the economy, that we may have a little bit further room to run here in terms of higher yields and, more importantly, a steeper curve. And so what that's done, Mark, is that's fed itself into this whole idea of dispersion along the Treasury curve. Dispersion is important. It's kind of an important fundamental building block for markets, because when you have dispersion, you're trading not only in terms of maybe a macro view, but you can also trade with a relative value concept. You're going to find bonds or points on the curve that are cheap or expensive relative to one to another, right? And so that kind of helps volumes, that helps opportunities and things like that. So the dispersion trade in Treasuries with the steeper curve is certainly very important. And you kind of see that in a number of different ways. A, you're seeing increasing volumes in Treasury futures and options, which are which is very, very important. 10-year notes, for example, 10-year note futures really spent a lot of Q4 circling around the 139 strike in the lead contract. Now we're trading below 137. So the dispersion trade and the sell-off has been great. Likewise, too, bank stocks. Bank stocks are doing well. The BKX index has taken off as Treasury yields have kind of risen on the long end of the curve, and the curve has steepened out. It's great for lending. It's great for capital markets businesses, capital markets franchises within larger banks, and it presents opportunities that bank desks can't take advantage of, i.e. the bank desks start coming back into the market. Flat curve, zero rates, not a whole lot of fun. So, we're starting to see a little bit of activity within the Treasury market, which is great on a year-over-year basis because the volatility that emanated in our market, in the bond market, from COVID was historic. It was off the charts. It was a 4, 5, 6, 7 standard deviation move from the mean, and a lot of players really couldn't trade those markets given risk sizes, limits, everything like that. And then following that, last spring, we went into a very low volatility environment where basically treasuries were pinned. I mean, there wasn't a lot of risk being put on ahead of the election. There wasn't a lot of risk being put on in treasuries because of the lack of yield there, and there wasn't a lot of risk being put on treasuries given what was going on with COVID. So as those fogs lift, right, we're seeing the curve steepen, we're seeing volatility rise, we're seeing opportunities arise that we haven't seen in about a year, and so we're seeing players come back in, which has been a welcome reprieve to those who trade it and to those who sell it.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, let's dive deep into all things rates here on the show. I know Mr. Rhodes, wherever he is out there, is smiling. He always wants more rates on the show. Let's dive in. Let's cut that curve kind of in the middle there, John. You're talking 30-year, you're talking front end of the curve. Let's go to the 10-year and see what's lighting it up kind of in that middle portion of the curve. And it's, spoiler alert, listeners, a lot of paper coming into showtime. Almost 3 million contracts on the tape right now in the 10-year, 2.95 million to be precise. We're looking at it, almost a 137 strike being closely at the money. 136.295 is where we're printing in those futures right now. Let's see what the most active month is. It's actually going out here to February. We got the February contract doing nearly 50% of the paper this week, 48.3% to be precise. So we're going to hang our hat out there. That contract, by the way, if you're wondering, it sounds like a long time to go, but it's only got 15 days to go, listeners. So it's not that much time left, just barely making it in under our 2-week frame of reference there for analyzing things like skew. If you're wondering, let's talk vol now. A little bit of a different scenario from a volatility perspective than what we were just talking about, which was crypto. That was around a 150, what we were just talking about. Longer term vol on the treasury curve, a little bit less, to the tune of, we're looking at a 3.25 right now. Down a third of a point, so still a pretty big percentage move from a vol perspective out here in the 10-year, but not a lot of, shall we say, overall vol to crunch here on the show today. Let's look at the skew, if you're wondering out here. Last week, the puts 2.4% rich. They were leading the dance. This week, even richer, 6.1%. The calls kind of unched to the at-the-money last week. They're about 1.3% cheap. This week, a lot cheaper, 10.1% cheap. So calls getting hammered, puts getting bid up out here in the 10-year. Let's look beyond to see what our most active trade was here. For the week, I said we're at about a 136.29. It's at the 137 even puts. They were leading the dance, but just ever so barely. They did 221,000 That's a ton of paper. That's more than most of the complexes we're going to talk about here today combined, listeners, and that's just in one option and in one strike. So that's a lot of paper. But they just barely edged out the 136 half puts that went up in March. They did 220,600 out there, so that's a clear number two. But number one was, of course, the Feb 137 even puts. They went up pretty actively. 81,500 trading today, 69,000 trading yesterday, 45,000 on Monday, 25,000 on Tuesday. Let's look really quickly at those 136 half puts in March as well, because they just ticked up again. They're getting closer as we speak. 115,000 are on the board today, listeners. So those are blowing the doors off of it today. 29,000 yesterday, 46,000 on Tuesday, 29,000 on Monday. Again, it puts some of the numbers you talk about in our other complexes in perspective. Just how much paper is going up out here. Just extreme moves. Let's look really quickly to see if we see any other really aberrant paper going up out here. Doesn't seem like it. It's mostly what you expect here from a lot of your rates products, lion's share of the liquidity. Very sizable, and most of it centered around or very near to that at-the-money strike, and most of it in that 1 month, in that Feb contract that has nearly 50% of the paper out there. John, any of that surprise you out here? And we're breaking down either from a vol or a skew or an activity perspective here in the 10-year this week, sir?
Not really. Again, to your point, Mark, I think it's been more of a gamma trade, right? I think that certainly the Democrats winning both Senate seats in Georgia kind of has given the market the feeling that perhaps Democratic gubernatorial or governance leadership will be emboldened perhaps to go big in terms of stimulus early on in the Biden administration, and so gamma, those Fed expiry late January options have really the payer skew or the put skew has really kind of risen on the back of that. But no, I think that look, I think what we think is that there could be even a bigger, larger move here eventually. Look, I think that the progressive wing of the Democratic Party is coming to power with emboldened and pretty bold ideas, whether it's infrastructure, Green New Deal, health care, college student debt forgiveness, things like that. And so really kind of what the market has told you in the short term is, hey, look, we may have gotten stimulus in December from the outgoing Trump administration or outgoing, Republican GOPs in the Senate, but really kind of, after January 20th, this thing could go big in February, March, and then really big later on this summer. And so, but the trade's being driven by the very long end of the curve. And look, with PCE at 1.2%, it's hard to argue that a 10-year Treasury at 1.10% offers a little bit of value. It doesn't, and the same with 30-year Treasuries. And likewise too, I think it's important for listeners to know that, in our opinion, at least here at RJ O'Brien, we think that policymakers actually kind of want to see a little bit of an uptick in inflation. Money supply was up, as you know, up 27% in Q3 and Q4 of last year, following the COVID recession. That compares to a number of about up 10% in the global financial crisis. And so they really they went big and heavy. And so kind of what we're looking for now is what happens with the velocity of money. And we think that in the near term, with even more stimulus coming through, that the velocity of money will pick up. We will see an uptick in inflation. I don't know if it's sustainable or not, but we will see an uptick in inflation. And treasuries just don't offer value. And so that we think that between near-term stimulus, March and April, and then something bigger, June, July, or August, treasuries still have a little ways to go to reprice in terms of higher yields.
All right, let's keep on rolling. We could probably spend the rest of the show just talking rates. There's enough paper to break down out there, certainly. Let's keep on rolling. We touched on it a little bit earlier in the show. Let's hang our hats now in that realm. A lot of you are fixated on these days. Yep, it is time to talk about equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Let's talk some equities. You guys are keeping an eye out there. Certainly, it's been a tumultuous week from any perspective, and certainly seen that reflected in the equities as well. Coming into showtime, we are seeing, of course, most of the major indices were in the green again. So interesting stuff to pay attention to out there. Small cap vol, though, it's people always associate equities downside equals an increase in vol, upside equals a decrease in vol. Yet equities are moving. We're talking close to 2% a day in some of these major indices. So movement translates into vol. I don't care what direction it is at the end of the day. That's why we're seeing RVX maintaining a 30 vol. It's actually up a point from where it was on our last show, because small caps, go figure, they're moving. Listeners, so it doesn't all have to be sell-offs to keep vol elevated. Movement translates to vol at the end of the day. VIX coming to showtime was a little bit shy at 23, 22 and 3/4. Puts it up about exactly a point from where it was this time on our last show. VVIX, which is the vol of vol, up about 2.5 points, about 112. So not quite as high as it has been of late, north of 120, but still pretty frothy at about a 112. And the newest addition to the vol landscape, VolQ. You guys can trade them up over there at CME Land at about a 24. It's up about half a point. That's, of course, the at-the-money vol of the NASDAQ 100. That puts that VIX to RVX spread, so that small cap to large cap vol spread, at about 7.25 points, which is pretty much exactly unched where it was on our last show, which is kind of interesting and surprising. We've seen both of those indices kind of keep that same exact pace over the course of the past few weeks. Remember, we didn't break down a weekly analysis on the show last week, so this is going back a couple of weeks now on the show, but unched from the last 2 weeks. And the VIX to vol Q spread, which again is a little bit of a different beast, but still interesting to look at. The S&P 500 to NASDAQ vol spread, that's about 1.25 points. It's actually about half a point tighter than what it was this time last week. John, I know you guys over there at RJO, I'm sure a lot of your clients are slinging a lot of E-minis over there these days. What's lighting up your tape from an equities perspective these days? And what are the clients hitting you up about?
Well, look, I think Sean hit on it earlier, right? There's been a real rotation trade, out of large cap technology stocks and into Russell 2000 futures. That's really that's been the biggest trade that we've seen. Early on in the year, Mark, it's hard to forget, right, that we all kind of started up again on Monday, but and Monday, we saw a relatively large sell-off, only to see now stock indices up pretty sharply for the year, and I'm not quite sure they can maintain this pace on an annualized basis. So look, on a technical level, using things like relative strength indicators, Bollinger Bands, and other things, I think we're quickly approaching levels where maybe equities are going to be seen as a little bit short-term overbought. There'll be a lot of good news priced into them, and in the bond market, you could see on a very short-term basis, using technicals, that maybe bonds are a little bit oversold and maybe due for a bounce. Maybe not an investment, but maybe a bounce. So that having been said, but for us, it's been the rotation in the small caps, right? With the idea that, hey, look, we're going to have an economic recovery in 2021, and small cap stocks are going to benefit more, most on a relative basis. Large cap technology stocks have come so far, really sort of led the rally, post March, that there's been profit taking and a rotation out of NQH and NASDAQ futures into Russell futures, with the idea that this economic expansion is going to broaden as fiscal authorities stimulate the economy even more.
Interesting. Well, let's hang our hat then out there in small caps. Folks rotating into the small caps, like we said, at about a 2089 as of a few minutes ago here, listeners. So that 2090 strike is right around our at the money there. The most active contract out there on CME this week are the contracts actually going away in about a day, doing 30% of the paper this week. Let's see if we can find a little bit longer term contract to analyze out here. Let's go out to the week 3 in February. Did about 15. Actually, no, I take it back. No, that one's only about 8 days as well. So many weeklies. And here we go. Let's go out to the week 4 of January contract list. That has exactly 15 days ago. It did about 15.5% of the paper this week. So that's where we'll hang our hat this week. If you're wondering, small cap vol, we just talked about RVX, but the vol out here on this contract, 25.2, coming off a little bit, off about 2 points so far on the week. Skew-wise, small cap's been interesting to watch. Remember, we had Matt on the show a couple of weeks ago breaking down what he termed to be activity in the 5 delta calls in the Russell 2000 that he's never seen before in all the years he's been crunching the numbers on skew and the various indices. So folks have certainly been flocking to some upside of late in small caps. Let's see if that's reflected in the skew this week. Last week, the puts were 14.3% rich. This week, 14.7%. So puts getting a little bit more bid. Calls 9.2% cheap this week. A little bit cheaper, 11.2% cheap. So coming in about 2 more points. So interesting. Of course, as we're continuing to rally and break through some of these strikes, that could probably be the reason why we're seeing some of those calls come in as well. In terms of the most active trade out here, usually when we're talking about Russell 2000, we're talking about pretty far out of the money puts. That seems to be where everyone's hanging their hats out there, but actually that's not the case anymore. Maybe that's a sign as well, Sean, that the worm is turning out here in small cap, because I'm seeing pretty much all calls all the time. The biggest print here is the 2,100 calls going up this week. These are in the monthly Jan, and then we have the 20 half calls also very active, going up. Actually, those are number 1. I take it back. 20 half calls going up in the week 4 Jan were number 1, and they were also active. It's 2,100 and 20 half calls pretty much across the board, Sean, lighting up the tape. So a little bit different paper this week, which is kind of interesting. Maybe, again, going back to what you were talking about earlier and what John was just alluding to, this rotation trade. It certainly seems like, at least this week, the options paper on CME taking a little bit different tilt, Sean, and going all calls all the time as opposed to farther out of the money puts, Sean.
I'm not surprised at all. I was on the show with Matt a few weeks ago. It was a fantastic discussion, how there was just so much activity in call buying going on in the upside calls of the Russell 2000. And again, that was before Russell 2000 was trading 2000. So now you got the 2100 calls trading in size. Not surprised at all. Again, there's two sides to these trades. There's somebody harvesting that vol. There's somebody buying upside for a reason. Really interesting to see. And it's also interesting to see the skew staying sharp on to the downside, which, as we know, for all traders out there, the Russell 2000 is a volatile index, right? So there is always going to be that sharp, steep curve to the downside for protection. But you know me, I'm one of those guys that have always preached buy puts when you can, not when you have to. But this market is just fantastic. Russell 2000's outperforming large caps, right? It's for the year. I know it's only a few days, but we're up 4.6% to a flat Russell 1000 or large caps. So very interesting to see. It's going to be an interesting first quarter and second quarter this year, but 2021 is going to be one of those fantastic years, and I think volatility's here for a while.
Hey, take your victories where you can get them, Sean. So the year's only a few days old. Take them. Take your victory. Do your victory lap now, because who knows? We've all learned, if 2020 has taught us nothing else, Sean, is that we have no idea what's coming around the bend. So take your victory lap now, sir. All right, we're going to keep our victory lap on the show going right on into our next product. It is time to break down that one I know a lot of you guys have been watching out there as well. Time to talk a little bit the old energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, buddy, welcome to the energy portion of the program here. Nat gas was number 2 on our movers and shakers this week, up nearly 7%. Nat gas is always swinging all over. So I think we have to look at a WTI a little bit as well here. That is a huge week just this week alone. Remember, our This Week in Scans go back to our last episode on Thursday, but our This Weekend reports you guys generate on the website, they start from Monday. So if you look at it from that perspective, WTI is up over 5% already this week. So a crazy week here for WTI. How long have we been talking on this show? It seems like forever. This dance around the 40 strike, the 40 handle, will it maintain north of 40? Will it sell off again? Will it rally? Well, we've been north of 40 for a little bit now, and now listeners come into today's show north of the 50 handle, 51 or 50.95 actually in that front future there. So just insane. We saw a little bit of action out there. Of course, OPEC shifting from their quarterly meetings to their now monthly, effectively, which probably is more in keeping with the action that's going on out there in the markets. Saudi's also making a little bit of a surprise additional cut, a little bit of a boon, a little bit of a early New Year's gift here for a lot of the crude bulls out there, because they're helping to extend this rally. Coming into showtime now, we're seeing the Feb contract that has only 7 days to go doing about 36% of the paper. By the way, if you're wondering how much paper is on the tape this week in WTI, 605,000 contracts. A very active week, but again, that puts in perspective what we were just talking about, things like the 10-year with 2.9 million. Very active contracts out there, but not much vol. It's very fascinating to talk about. Speaking of the vol, in that Feb contract, the vol right now, 51. But let's go a little bit farther out, just because, as we said, we like to give a little bit more meat on the bones than just 6 or 7 days. Let's go out to the March contract. It did 25.2% of the paper this week. That has about 41 days to go. The vol out there still, let's see, I said it was about 33.5 on that 51 strike future there. It's a 32.3 at the money vol out here in March. Again, we're threatening that 51 handle right now, listeners. Looking at the skew, we see the puts 11.9, almost 12% rich. So puts getting a hefty bid as we're crossing through this 50 handle. The puts last week, they were 11.9% rich last week. This week, 11.2% rich. So still a very firm bid, coming in a little bit on the put side. Last week, the calls 7.5% cheap, so they were offered. This week, 5.9% cheap. So calls getting a little bit of a bid as we explode through the 50 strike out here. In terms of what the most active contract was this week, what the big print was out here, It wasn't the 50 calls. You'd be forgiven for probably assuming that. Most products, including WTI, like a nice round number, a nice even strike, but it was actually the double calls, the 55 calls leading the dance out here in March to the tune of 19,579. The lion's share actually coming today, nearly 7,000 on the tape today, about 5,000 yesterday, almost 6,000 on Tuesday, and about 2,000 on Monday. So a pretty active day out here. I think that rally north of the 50 strike seems to have driven a flurry of paper out here. And then number 2 goes out to the 52 calls that are going away in February. So they're going out in about 7 days out here. These have 16,000 contracts on the tape. The lion's share yesterday, 4,885, 46.63 on Tuesday. So a pretty active week out there as well. Seems like they're slightly closing here on the latter portion, about 3,000 going up today. So maybe some closings on the 52, maybe rolling to the double. Either way, interesting upside call activity, as you probably would expect here on this week where we're north of the 50 handle. Let's look, as we like to do, a little bit farther out, see if we can find any interesting paper on the tape in terms of esoteric strike selection. 45 puts are pretty active right now out there in September, have done about almost 7,000 contracts so far this week. 45 puts also active in DEES as well with about 3,000. So about 10,000 contracts on the 45 put strike, which isn't that far in the rearview mirror, listeners. If you look back a couple of weeks, we were at 45 not too long ago. If that's not bearish enough for you, if you go out to DEES of 2022, doesn't that sound so futuristic? It does. But it isn't that far away. 35 puts, sliding it up to the tune of 3,000 on the tape this week. And DEES of 2023 playing a similar game, 30 puts with about 1,300 on the tape. So weird stuff afoot out here in the crude markets, even though it is mostly all calls all the time. John, I know energy has been a recurring theme of the year, and a lot of people had their attention focused on energy back in the mad dash to negative we saw back last year in April. But what's been lighting up your tape these days at RJO, and what are customers calling up about in the energy complex these days, sir?
So the energy complex, Mark, has really sort of been a trade on the dollar. Right, and so the energy complex has kind of rallied as the U.S. dollar has traded to essentially 32, maybe 34-month lows against some of the other major currencies, and so it's been very much a barometer of that. Likewise too, within the oil sector specifically, institutional investors are carefully watching the price of oil because at $50 a barrel oil, shale production fracking production once again becomes somewhat profitable. After a long stretch in 2020 where a lot of the frackers went out of business and had to kind of suspend operations because it wasn't profitable, what our institutional investors are kind of watching very carefully is what goes on with crude in the immediate months as the supply of dollars and fiscal policy and monetary policy remains easy, but also too what goes on in terms of high yield bonds in the fracking and oil industry, and will there be defaults? We think the policymakers may be very sensitive to what goes on in the oil industry and defaults and perhaps credit stresses within junk bond space. Should credit defaults and should bond defaults in the energy space rise? And I would expect policymakers to be very sensitive to that. Likewise too, right? You do have kind of this whole idea too of a kind of a newer government coming in line with the whole idea of the Green New Deal. And so with Joe Manchin, who's running the Senate Energy Committee as the chairman from West Virginia, think Western Pennsylvania, think fracking, think electoral votes, electoral college, all that type of stuff. It'll be interesting to see sort of what goes on within the energy sector as well in terms of new regulation as regards Green New Deal regulation. But in the meantime, in the short term, we're really keeping an eye on the price of oil because nothing solves low supply like low supply. And at $50 a barrel, and with the Saudis having voluntarily removed the production that they did, will frackers come back online, and will we see crude maybe head back down towards that 45 or 40 level during the course of the year as supply from domestic frackers comes online? That'll be the trade.
Fascinating stuff to watch. We also like to watch what you guys have on your brain. So without further ado, let's see if we can squeeze in a few of you with your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. Facebook.com/The Options Insider, StockTwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, let's get into it. We got some epic treatises in store for us today. Next up, Rhythmic Angel's name sounds familiar. I think he's written in before. He says, "Hi, Mark and team. Happy New Year." Well, thank you, Rhythmic Angel. I like your handle. It's an interesting handle. Great show, and good luck in the new year. Well, thank you. I think we could all use a good dose of luck after the mad year that was 2020. He says, "My question is around the DOM, the DOM, a.k.a. the depth of market, listeners, trading that most traders look at for futures provided by TT or CQG." He loves the TT questions here on the show. He asked one, I think, recently, too. "As you know, is essentially is a feed from CME's Globex, I believe." He says, "I could be wrong on that. This shows the orders of the different strikes in a commodity future. Could you advise from your experience, does this kind of trading, i.e. looking at the order flow using the depth of market especially, does that still work? It sounds almost too good to be true in today's environment, or have orders moved towards a more of a black box style of trading liquidity? I do realize there exists the option for big market makers to hide their orders in block trade so they get a better fill, which means using any tool, you'll not be able to see this order flow." I understand it's a broad question, but would like to hear from your experience looking at order flows intraday. Have you seen markets move towards a direction where there was no sign of a large order on that strike, as if there was hidden order flow on that strike? Thanks. Well, I think no matter what product you're trading, Rhythmic Angel, anyone else, whether it's a future, whether it's an equity, whatever the case may be, I think you need to have that information at your disposal. I'd be hard-pressed to try to trade something without looking at what's going on out there in the book. It is vital information. You want to know if there's, let's say, a 10,000 lot of calls lurking in the book somewhere, or in your case, maybe a couple of thousand futures lurking somewhere that you didn't know about that could potentially run you over or provide a support for your price. So I think that information is very viable. I know you're talking about blocks, and those do get crossed. You're right. So they're not resting in the book and therefore displayed in the depth of market and then executed. They're kind of crossed, upstairs and then printed. So you're not seeing that flow. That's correct. But seeing the depth of market, I think, still has a lot of value. If for no other reason, it could help when you're looking at talking intraday. I think it's very valuable intraday because you're going to see markets kind of bouncing off levels where there are huge amounts of resting orders there, or vice versa. If they're rallying and there's a ton of open interest on a strike, or a ton of orders lurking on a particular strike, or a future willing to sell at a certain price, it's going to bounce off that as well. So you're going to see a lot of intraday fluctuations driven by the size that's available in that order book. So yeah, in general, having knowledge of what's listed in the order book is a useful tool. I would not be shy about using it in your trading there. John, is this a tool you like to use a lot over there in your trading and recommend to your clients, the depth of market tool, sir?
No, absolutely. Mark, we recommend it to our clients. We use it, and we use kind of functionality and algos that can sort of hide what we're up to as well. So it's not just the liquidity providers and market makers or the black boxes that sort of have that function. We have it as well. And look, especially within option space, when you're sort of maybe dealing in the 20 and 25 delta space, maybe up to even the 40 delta space, right? And you're maybe kind of doing covered volatility strategies, for example, or whatever else. It's kind of a nice way to sort of, kind of see what else is out there in terms of mid-market prices. And so there are functions out there that we use, and we encourage our clients to use. Ghosting is another term that's become kind of popular, or within the market vernacular, being able to sort of ghost orders a little bit in terms of, look, if it's 6-8 and there's 100,000 each way, why not see what's out there at 7? Right, and ghosting orders or iceberging orders, another kind of term that's kind of used out there, is kind of certainly an advantage that all parties can use. And the exchanges have been great, and the technology providers have been great in terms of allowing us those tools, without question.
Yeah, this is useful information. Even if you are not seeing the full picture out there, Rhythmic Angel, you're still seeing more than you would otherwise. And so it's definitely useful. Here's an interesting question. Let's wrap up on this one, John. This comes from Alan. Alan wants to know, do we see a similar retail one-lot explosion in futures options that we saw in the equity options market this year? John, this has been a recurring theme. In fact, we talked about it and named it one of our trends of the year for 2020 was this just explosion of call them whatever you will. He calls them one-lots. People call them the Robin Hood crowd, whatever you want to call them. The small retail options traders hit the market in mass last year. A lot of them trading your traditional equities, your Apples and your Teslas and maybe a little bit of S&P out there. But as Alan wants to know, did you guys over there at RJO and other futures options brokers, did you see a similar explosion from the one-lot retail crowd, John?
Yes. Now, yes, did we see it on our desk specifically, Mark? We did not. But listen, within the industry as a whole, without question. And look, I mean, when people are asked to stay home and to quarantine or to not go out, and government is providing stimulus or financial support, yes, there becomes a greater retail interest in terms of markets and maybe putting excess liquidity or savings to work, and that's definitely taking place. Likewise, too, not just from that market phenomena or that economic phenomena, but also too from the exchange level. The corporate client, the institutional client space is very well worn. Whether it's large investment in commercial banks out of New York or the exchanges, whatever else, most large institutions and mid-sized institutions know where to come, know the products, have sales relationships, have bank relationships, and can use these products. So for the exchanges, from from that point of view, the move into retail product, the one-lot trader, has become sort of the last and next bastion. And so I think the exchanges have been particularly smart and keen to sort of move that way. And what I think the exchanges are doing in some ways is they're competing with some of these online brokers. We'll use Charles Schwab, for example, where now with Schwab, I see you can go for $5 and buy partial shares in equities. And so I kind of think that, again, it's just sort of dialing down a little bit more into the retail space, into that single contract or dual contract user in terms of, here, please come use our products. And I think the exchange has been smart about it.
I couldn't agree more.
All right. Everybody, that music means we come to the end. Man, how fast an hour flies when you're having fun talking about all things futures, options. John, once again, you did an able job holding down our CME Group hot seat this week. So before we go, if listeners are intrigued, they want to reach out to you guys over there at RJO. Maybe they're part of these one-lot hordes. Maybe they're more on the institutional side. Where should they go? What should they do, John?
You can always email me. I'm at jbrady@rjobrien.com. Or you can always kind of give us a call or visit our website. Our phone number here is 312-373-5000. But I would actually kind of maybe steer people towards our internet portal as well on our website. From there you can learn more about not just the products we offer, but also about the great history of RJ O'Brien. So I'd encourage your listeners to do so.
There you go. Check him out. You can also give him a follow on the old Twitters at RJ O'Brien is the place to go. And Sean, if they're intrigued, you guys have all this data you were just crunching at the top of the show about how Russell 2000 caught up to the large caps, some of the other interesting stuff going on out there. Sean, if folks want to check it out for themselves, where should they go? What should they do?
Mark, once again, and John, what a pleasure to be on the show with you. I'm going to say it again. I can listen to you all day. Just a fantastic discussion today, and it was just really fantastic to be a part of it with you today. So thank you, and Happy New Year to you as well. Sean.smith@lseg.com. As you know, my email address has changed. Our parent company is London Stock Exchange Group, so LSEG. But a lot of information on our website, FTSERussell.com, and I referred to a recent blog in some of the comments I made today by our illustrious Philip Lawler, If you go to FTSERussell.com/blogs, you'll see one titled, After the Q4 Surge, Russell 2000 Ends in Dead Heat with Russell 1000. That's the title of the blog. It's got lots of information in regards to small caps performance throughout the year and how it finished up at the year with some really nice graphs and some really good analysis in the various sectors within small and large caps of why performances have done what they've done. And we've talked about sectors on the show quite a bit: healthcare, technology, financials, and others, and reasons what are driving these indexes. But this recent blog by Philip has just really got some really good information. So please go to FTSERussell.com/blogs. You'll find some really, really good information there.
There you go. Check them out. FTSERussell.com is the place to go. You know where to go to find all that info we're talking about here on the show. CMEgroup.com/TWIFO. While you're heading over there, of course, check out the research and the data and the education, everything they have over there as well. And on behalf of Sean, everybody over there in FTSE land, and of course everybody over there in CME, and our guest John, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in questions, for voting in your polls. By the way, we have a poll running right now. If you haven't played yet, get on over to @options, make your voice heard. A very simple one to kick off the year. Just quite simply, you think equity indices will close higher or lower on the year for 2021. Get over there @options, make your voice heard, and we'll see you back here tomorrow, noon Central, 1 p.m. Eastern, to kick off the year on Volatility Views, and then we'll be back again on Monday, kicking off the whole week again on the option block all the way through to Thursday, and another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.